Hey everyone, me Kevin here. The Federal Reserve is expected to announce a decision to add stimulus to the markets this Wednesday. But the Federal Reserve's stimulus works in wacky and bizarre ways compared to stimulus from, say, the Treasury Department, which can just straight up give us money, like unemployment checks through the states, or just send us checks eventually through the mail called stimulus checks. The Fed, though, focuses more on businesses and industries and the flow of money and banking. So when we look at Fed stimulus, it tends to be a bit more complicated, but I'm going to simplify that and explain it as easily as possible here. So here's the thing. The Fed is considering two things to help stimulate the US economy for the recovery, basically trying to sustain the recovery we have. Remember, these things are weird, so when you hear these two things, you gotta keep in mind what they mean for you. For example, when the Fed says we wanna keep interest rates low, we think to ourselves, okay, that means cheaper car loans, probably cheaper home loans, cheaper credit card debt, and if we're saving, it also usually punishes us because it means lower rates on savings. So, in other words, they kind of motivate us to go spend money on our side hustle, stocks, or real estate. All right, so here's what the Fed is thinking and how that would eventually affect us. So, stimulus idea number one is this complicated thing called a cap on yields of treasury bonds. That sounds really complicated and like eye roller, right? Well, don't worry, get your life insurance down below if you get confused. In the meantime, here you go. This is how that would work. Let's say somebody owns a treasury bond, and this is that treasury bond. You see, it says T-bond and $1 on it. Basically, whoever holds this gets $1 in interest. Well, if I sold you this piece of paper for $100 and you got paid $1 in interest per year, that would work out to 1% interest, right? And if that happened a bunch of times, well, then the market rate would be about 1%. That's kind of how the market interest rates work. Obviously super simplified, right? Well, what happens when the price goes up? Let's say I go to the, around to the market where treasury bonds are bought and sold. I'm like, hey, who wants to buy this for $100? And nobody's there. And then all of a sudden the doors open up, Jerome Powell walks in and goes, how much you selling it for, Kevin? I go, I just want $100. He goes, how about I give you $200? Wait, why would you do that? There's nobody else here. Kevin, I got the money printer. Here's $200. And you're like, dude, okay. So now Jerome Powell bought this treasury bond that was yielding 1% for $200. And so I give it to him. And now all of a sudden we've established a new market interest rate of, well, let's see, $1 on $200 is only 0.5%. So market rates just went down because Jerome Powell came in and started buying everything up. He's the buyer overpaying for everything, basically. And all of a sudden, this is how yields on these fancy complicated things called bonds can lower, and mortgage rates and car rates and things like that tend to follow treasury rates, not necessarily that discount rate we keep hearing about. So on the flip side, just to kind of show you how this would work, because this is an extreme example, right? Let's say the Fed didn't step in. And I'm like, hey, who wants to buy this for $100? Crickets. Nobody's there. Well, what do you do when nobody buys your stuff? You drop your price. So let's say I drop the price of this piece of paper from $100 to $50. Now, if somebody buys it, they still get the $1, right? Because it says $1. They get $1 per year. That's what it says. That didn't change. Like, all right, I'll take the $50. Here you go. I give them the bond. They give me the $50. We just established a market interest rate of 2%. $1 on $50 is 2%, which means average rates just went up. And so by the Fed coming in and basically buying everything, or potentially even overpaying for these bonds, because they're printing money anyway, like they have an unlimited supply of money. They've literally said they have an unlimited supply. Well, duh, they have the printer. I guess they have unlimited ink as well. Basically, they got enough money, okay? They can buy whatever they want. That, in a way, can make sure the Fed keeps rates as low as possible. Now, let's talk about the second thing they're thinking about doing. So that way, when you hear about this coming up this week, you've got some more clarity on what they mean by all this stuff. So here's the second thing. The second thing is, and again, get your 2 free stocks in life insurance. Links down below, okay? Just make sure you deposit your $100, then you get your 2 free stocks, because you're gonna need it when you hear this stuff. It's nuts. The second form of stimulus the Fed is considering is literally a fancy way of saying they're gonna talk more. That is, they're going to provide more forward guidance. And look, I know maybe I'm being I'm being facetious here, right? Like, don't take me literally when I say they're gonna talk more, but that is basically what they're doing. It is a good thing though. See, when the Fed provides more guidance and they say something like, all right, we're gonna keep interest rates low through the end of 2021, which they've already said, that gives us comfort. That lets us say, okay, cool, I've got until the end of 2021 to go buy a house. I could go flip real estate. I could speculate within that time frame. I'm not worried about the Fed all of a sudden jacking up rates on me and pulling out the rug from under me, hurting all my investments, right? Well, they might come out and potentially say, we're not gonna raise rates for the next 3 years through the end of 2023. If they do that, you could probably expect the stock market and real estate market to react very positively because they haven't been really good about giving that kind of guidance in the past. They're usually really cryptic. Like when I go through and I read the words of politicians and I'm like, okay, let's try to read between the lines here. Let's get some guidance. The Fed, you gotta like 10x that effort because they are cryptic and they're trying to become less cryptic to give us more guidance. So that's basically what the Fed has for us. So huge thank you to the Wall Street Journal for inspiring this distillation. Obviously, I encourage you to check out what the Wall Street Journal had to say. Again, their articles can tend to be a little bit more complicated, but you might consider giving that one a read. I will link it down below. Obviously, in the links down below as well. If you like the way I explain things, consider subscribing to the channel, consider joining me in my courses, and of course, 2 free stocks with Webull and life insurance. Thank you so much, everybody. We will see you in the next video.